Welcome. We are moving now into session 1 about concepts. This session covers the key concepts that we want to use in entrepreneurial finance. First of all, the most important thing for us is to try to understand and define what do we mean by entrepreneurial finance and why is it a combination of these two words like entrepreneurs or entrepreneurship and finance. We take a step back. We look at what is first accounting. When we think about accounting, accounting is meant to be the language of business. So what we do when we talk or discuss about accounting, what we are trying to do is we are trying to see how things are getting recorded. So any transaction that happens in a business, any exchange, how does it get recorded? How does it get coded into an exchange between two parties? Then accounting is the answer for this. Accounting develops a set of rules, concepts, protocols that allow us to record those transactions. What is happening also is that accountants are trained then to record and code all those transactions that happen in a business. Hiring someone, selling a product, exchanging an asset or acquiring an asset or getting rid of an asset in a company. However, accountants are not trained to understand or talk or discuss things with entrepreneurs, and they are not usually very entrepreneurial in the way they think. They actually prefer to be able to record and control and record things properly. So accountants might know little about what an entrepreneur or an innovator does, and actually maybe an entrepreneur and innovator knows little about accounting or finance. As we can see, they have different ways of looking at reality. While an accountant would prefer things to be stable, organized, and structured, an entrepreneur or an innovator, and again this is a bit stereotypical, but they would like things to move, change, evolve as much as possible. So, although accounting is the language of business, accountants are most of the time trained to work in large, established, well-organized firms. This is not the same situation that a project leader might have, or maybe an entrepreneur that has kind of a high dependency in their own activities on what happens with their project and how it evolves. And they need this flexibility, ability to change and move all the time. At the same time, we also have the concepts like diversification or risk might feel very different if you are leading an innovation project or a tech startup versus if you are in the accounting department of a company. What we mean here is that the idea of what is risk, for example, an entrepreneur might see a project as very likely to be activated or something in the future that it's very possible that it will go ahead, while the accountant might say, sorry, this hasn't yet happened, I cannot record this, or we cannot assume that this is going to happen the way you see things going. These different mindsets are actually sometimes difficult to put together. So we need something that helps us to agree on get on the same page between the accounting or the accountant protocols and then the entrepreneur or innovator in the project. What we use are the financial statements. What are financial statements? Financial statements helps us to understand and see information about what is going on in a company, in a business. And basically the focus is on financial information. Why are they important? So, financial statements give us critical information about the business. And this is very useful for outsiders, people that are not able maybe to be following the business closely in their day-to-day operations. They still would like to get an overview of what is going on. This is also useful for us because if we have some financial information in these financial statements, we are able maybe then to assess how is the operating effectiveness of that business. We can compare it to another business, we can compare it to the same business in maybe the previous year. It allows us to see changes and evolution, benchmarks. Also, more internally, financial statements are useful because they help us to make managerial decisions. They help us, for example, to see whether a product line or a business is not working well and maybe we should do some modifications. Or maybe if it's time to invest again and in that new market or that new product, and maybe to explore possible growth paths. At the end, also looking more from the entrepreneurship perspective, financial statements back up, complement our story. Without financial data, it's only a story. But once we can bring that data and evidence, it starts to become something that we can present as more plausible, as something that gets closer to reality. Also, if we prepare and develop financial statements properly, rigorously, they also raise the legitimacy of our company, our work. Being able to produce financial statements shows that we understand the rules, we are able to follow the protocols, we are able to follow the natural or normal conventions in the industry, so that our own general work that we do in our project can also be perceived as more rigorous and well organized. So it's something that has direct and indirect effects, and it's helpful in general to the audience that we are engaging with. So, how then we combine those two things, entrepreneurship and finance? Is entrepreneurial finance just a special type of finance? Well, actually, entrepreneurial finance, what it builds upon is this idea that establishing clear financial goals is a good idea. This helps us to establish a common language, a common path between the accounting or financial auditors, also with the project manager or the entrepreneur. This helps us to show that, okay, maybe we have a common ground that we can understand, and we use this maybe by defining financial goals. What do we want to achieve with this company, besides the social or other types of goals you might have? Then the financial statements become that tool that helps us to report and manage the growth that is happening in the organization, or the evolution. Maybe it's very stable or mature or slow developments. Also, this helps us to make decisions. By having financial statements, we can actually report, identify problems that should allow us to then take steps or take actions in relation to those issues. Very important, we also should be able, using financial statements, to then project things, look into the future. Forecasting then allows us to build and develop our expectations and translate them into a language where other people can also see what are the implications of our forecasts. It allows us to basically communicate with third parties. Very important also, financial statements are part of our work, and entrepreneurial finance has to use those financial statements to help us to build this culture inside the organization on how to manage effectively cash. So, when we discuss topics in entrepreneurial finance, at the end what we want is that we develop this lean way of working, where from day to day to the long-term plans, we take into account the cash needs that our emerging new venture might have. This means that we are able to see whether in 3 months or in 4 months we have to make a substantial payment to a supplier or give back some money to the bank. And then we can plan ahead, knowing that this is a commitment that we cannot postpone and that we need to be ready to respond. What we also want to do is to be able to raise funds and understanding what is the differences between maybe getting debt or equity. The ability to raise funds comes with the necessity to acquire additional resources that can help our project, that can help our venture to develop. Some people might say, look, I just work with customers and it's the customers that are financing me. But still we are using funds coming from the customers that allow us to run our business and develop our business. Last point, usually what we also discuss is that it's very nice that to talk about growth and development, but what happens when things either go very well or don't go well at all? This is the point where we need to discuss also what happens when we exit the business. If we say stop it, it's enough, we need to move in another direction. maybe because we get an amazing offer that wants us to sell the business, or maybe because we have to liquidate the business. Any asset that has some value, we need to get some money out of it so we can repay the people who have invested in our project. So a usual question that we get is entrepreneurial finance just another flavor? It's just another name, but basically we are talking about finance. Is it like traditional finance? Yes and no. So basically it's like finance because we are also talking about accounting concepts and central elements in financial management, but we are not talking, for example, that much about financial markets. We are not talking about how the stock market responds to exogenous changes or the tensions in the oil to make the price evolve, and then how does this impact the situation of some parts of the economy. No, this is not our focus. It's also not our focus to discuss about investment options, diversification, managing risk. It's not an investment analysis course. And also we are not going in depth into the financial management of an organization, all what it involves and the different aspects on the day-to-day financial management of a company. However, we need to be familiar with the three elements because in some cases we will be connecting ideas and relating to them. For example, what happens when we want to go and raise funds and the financial markets are maybe in a turbulent situation, or interest rates have changed recently. How does this impact to us? We need to know about this. How does this impact that our maybe growth plans are very aggressive when we look for investors? So maybe we will be using part of their resources for high-risk projects, but it will be harder for us then to appeal investors that are trying to diversify from these high-risk projects. The same way that we also need to know what happens when maybe our business needs to be change the financial management strategy. Maybe we need to start asking our customers to pay earlier. These aspects we will be touching upon. Something important that is particularly different in entrepreneurial finance is the absence of a path, a previous path, historical data. It's very hard then for people to assess risk based on our past performance because we are just working in new projects or new organizations, and that makes it particularly complex. Also, from the entrepreneur or project manager perspective, we are in a situation where the person cannot diversify risk. So when we allocate this idea that, oh, maybe you should be diversifying as an entrepreneur, says, well, my company is my life, so I only have one focus right now. I cannot be selling part of my company and investing in other types of companies unless I become kind of a portfolio entrepreneur or other types of profiles. But the whole idea here is that it's very hard for entrepreneurs to diversify in their asset allocation. They actually, a lot of times what they do is that they double up, they put more money, they even sell the house, maybe sell the car, put everything into this new venture that they are trying to push. And it's hard for them also then to liquidate and get some cash from some of those activities, as this is their main source and their main activity. So let's move into getting some examples. There are three examples that I want to share with you now. One is the income statement, balance sheet, and cash flow statement. What we will see are examples from a company called Vestas that they were reporting their different financial statements a couple of years ago. What we can see, and what I would like you to pay attention, is that the income statement traditionally follows always the same structure. So it starts by presenting revenues, it ends with something that looks like a net profit at the end. You will see that there are some specific terminology like EBIT or EBITDA. We will talk about this later in the future. What I would like that you pay attention now is on how those things are structured. So we start with revenues, and in this case they are showing us 2 years, 2016, 2015. It's a full year reporting. And then the next thing they show is cost of sales. Sometimes this is shortened as COS, but basically what we are seeing here is this key transaction that the business is running. How much they are selling, how much is this cost of sales, how much they have to pay to their even internal factories, how much they have to pay to get those materials, how much they have to pay to the energy bills or any other variable cost in this case related to their sales. In this case, what we also can see is that this company has been able to increase revenues faster than their cost of sales. This is a good sign, and this translates into a better gross profit. And it's quite spectacular in this case. It's not the usual, but they have improved from one year to another by 41% thanks to being able to sell more and to sell things that in this case they've been paying less. Either probably in this case it's because they've been selling products that they had bigger margin, or they've been able to improve the margin in some of their products that they kind of were able, maybe not, they've been able to save some of the production costs. On the other hand, when we look at the fixed cost that they have, here we see that actually they have increased, but they have not increased as fast as the revenues that they've been able to produce. When we try to see how this translates then into an improvement at the bottom line, that's where we go into the net profit. And interestingly, and in this case it's just coincidence, the net profit has also improved by 41%. So this improvement in what they report later, this gross margin improvement, has a big impact when we go then to look at the net profit. In this case, they also report some of the margins, operating margins, and also the EBIT margin that gives us an overall information on how this business is working, how effective it is in converting revenues into profits. You will see also on the right side and with the blue statements that those are the different aspects that they want to highlight, they want to emphasize. So let's look at another example. And here there is a caveat. This is a super short, succinct balance sheet. Usually there would be more elements and more aspects being reported. In this case, what I want to use this balance sheet is just to give you an idea of how does this usually look like. While the income statement is much more these transactions reporting, the balance sheet is, okay, what is in the company and what does the company own? So this idea of assets and liabilities. And we put them together in this balance sheet, but basically the first thing that you will also notice is that the amount of assets always has to match with the amount of liabilities. Otherwise, there are accounting ways to make those things match. Maybe if the company has huge depreciation on the assets, then there will be some types of liabilities that will be compensating that. What we want here is that you see that on the asset side, for example, in this case, the current assets have been increasing substantially, but then also they've been able to finance this type of increase of current assets as their business has been developing by increases in their non-current liabilities or even in their current liabilities. What we see here is that there has been an increase in non-current liabilities that is quite higher than maybe the increase that they have had in non-current assets. This points out that maybe the company has been able to find ways of financing their operations that offer them kind of a more long-term, more stable financing for the future. That could be something positive for them if they are able to start shifting. What this company also wants to us to pay attention, and this is what they highlight in these key figures, is how their net debt, net working capital, and solvency ratio have been changing. This is due to the specific attention that, in this case, that was being paid to the evolution of debt-related aspects. This was a company that was growing quite fast, and maybe a concern from some investors or some shareholders was, okay, will you be able to repay this debt in the future? Last but not least is the cash flow statements. Sometimes cash flow, the first time that we hear it, is a bit confusing, but the cash flow statement is similar to the idea of a profit that the company creates, but it takes a broader view. It basically says, if I was able to run this business, regardless of maybe my capital structure or the way I'm organized or how old my assets are and so on, how does this business look like? So am I able to generate a lot of cash that maybe I can use to either repay shareholders or invest in the business? Yes, no. So that's what it's trying to be capturing in the potential free cash flow that the company could generate. And that's what gets reported here, in this case, Vestas has been doing a very nice work on being able to generate more cash from their business. What they mention is this cash flow from operating activities before a change in net working capital. If we take 2 steps back, we can see how those numbers in relation to the balance sheet, and in the income statement, we can see that cash flow is more than the net profit. It gets much closer to the EBIT numbers that we have here. So at the end, this is to be discussed also in the future. This whole concept of free cash flow is something that we will be using later for doing valuation calculations. And we will also see how we get this number and why this number helps us to capture more the potential that the business has in the future. Finally, and this is just to highlight other aspects of this example, is when we report financial statements with this objective of showing what is going on in the company, sometimes we want to make a specific emphasis on legitimating or showing improvements in areas of our business. Those graphs that you see here, they could be about maybe the improvements on operating margins or other aspects. In this case, what they are trying to do is showing the changes in the net debt in relation to EBITDA. Or in other case, in the looking at the solvency ratio, how has it improved or changed? In both situations, you can see that there is an effort to report that there has been an improvement by showing what has happened in the last quarter. In both cases, they seem to be managing things a bit better or keeping things at least under control. They highlight, for example, that their net debt to EBITDA has decreased and also that their solvency ratio has been kept still under control, maybe not as it was maybe a year ago, but still developing and getting better. Again, what we wanted to see here, and with this we stop this in a quick introduction, is what was entrepreneurial finance, why is it important for us, how we combine those different viewpoints from entrepreneurs and finance, and what are those 3 statements that, as you will see in coming sessions, are the building blocks of our new understanding between the perspective of the project manager, the innovator, the entrepreneur, and the perspective of the accountant or financial manager.